Hi, friends. Welcome back to the Multifamily Review. I'm your host, Marcus Armstrong. It is March 2026. The spring leasing season is officially upon us. And if 2024 and 2025 felt like the industry was taking a deep, anxious breath, 2026 is starting to feel like the exhale. Today, we are looking backward to look forward. We spent the last few weeks digging through the Q4 2025 earnings calls from the Giants, Equity Residential, MAA, Essex, UDR, and Camden. These reports are more than just numbers, they are the narrative for the next 12 months. We are seeing a fascinating transition from a market defined by supply shocks to one defined by strategic retention. Today, we'll break down the regional divergence, the bargain stocks, and the one major outlier that is liquidating its entire portfolio. The dominant theme across every single call in December was the light at the end of the supply tunnel. For the last 2 years, we've been shouting about the record-breaking deliveries, over 547,000 units in 2025 alone. But as we sit here in March, the tone from the C-suite has shifted from caution to optimism. Equity Residential noted that the supply wave is dramatically declining, and they expect momentum to build as we move through the year. MAA was even more explicit, stating that while deliveries are still high, they expect the market to be very strong for the next few years. Yardi Matrix reported that average advertised rents rose by $3 in January, reaching over $1,700, ending a 5-month streak of declines. It's not a boom yet, but it is a heartbeat. However, if you look under the hood, the performance isn't equal. We're seeing a massive split between the coastal winners and the Sun Belt survivors. If you're operating in New York City or San Francisco, you're smiling. Essex Property Trust, which is heavily weighted in Northern California, reported revenue growth of 4.2% in that region. Why? Because the tech sector is expanding again, and there is simply no new housing being built there. San Francisco ended February with a staggering 5.7% annual rent growth, the strongest in the entire country. Now compare that to the Sun Belt. Camden and MAA are feeling the weight of what they called a 50-year record high delivery. Camden's same property NOI growth was effectively flat at 0.3%. And they are actually projecting a negative midpoint for 2026. Austin is still the epicenter of the pain, with rents down 5.1% year over year. The narrative for March is becoming much more clear. The coastal markets have already exhaled, while the Sun Belt is still holding its breath as it absorbs the final few months of oversupply. If you're in a high supply market like Austin or Phoenix, how are you surviving? The answer from the REITs is retention. We're seeing record-breaking numbers here. Equity Residential reported the highest full-year resident retention in its history during 2025. MAA noted that their turnover is at historical lows of around 40%. Why are people staying? Well, it goes back to the rent versus buy math we talk about nearly every month. As of early 2026, the average mortgage payment is roughly 38% to 40% higher than the average rent in major US cities. Even with mortgage rates easing slightly, they are staying above 6%, keeping the starter home completely out of reach. This has changed the operator's playbook. Instead of chasing new leases with expensive concessions, which are still being used by over 30% of properties, REITs are focusing on renewals. Because, as we know from our previous research, a single turnover costs you roughly $4,000. If you can keep a resident for $100 less than market rent, you're still winning by avoiding that $4,000 turnover cost. Finally, I want to talk about how these companies are using their cash. If they aren't building new projects because new construction starts have plummeted 71%, what are they doing with their money? The answer, they're buying themselves. Equity Residential sold off $1.1 billion in properties and used $300 million of that to buy back their own shares. The CEO put it bluntly, at this price, our stock is a bargain. UDR and Camden are doing the exact same thing. They believe the private market value of their buildings is much higher than what Wall Street says their company is worth. But the biggest story in the room, Aimco. While everyone else is trying to stabilize and grow, Aimco stockholders just approved a plan to liquidate the entire company. They are selling every single asset and giving the cash back to shareholders. They've already declared an initial distribution of $1.45 per share. It is a dramatic exit from the market and a signal that for some, the most value-add strategy left is to simply cash out. So, as we look at the spring leasing season, What are 3 things you need to take away from these earnings calls? 1, the supply is the light at the end of the tunnel. We are past the peak. If you can hold on through mid-2026, the pipeline gets much, much thinner. 2, location dictates your rent growth. If you're on the West Coast or in the Northeast, you have pricing power. If you are in the Sun Belt, your goal is occupancy and retention above all else. Finally here, the lifestyle renter is your best friend. People aren't leaving to buy homes. They are staying because they are priced out or simply prefer the flexibility. The market is normalizing. The frenzied rent growth of 2021 is gone, but the supply crash of 2025 is also fading. We're entering a period where operational excellence, actually being a good landlord, is what will separate the winners from the liquidators. Thanks for listening to the Multifamily Review. We'll be back next month to look at how these REIT narratives are playing out on the ground.